Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient.
This week, right after we had the First Republic Bank collapse, the Fed came out and said that the banking sector is really strong and resilient. It's almost like he had his speech written up already and couldn't be bothered to change it. Everybody can tell that the banking sector isn't obviously resilient right now, and it is going through some turmoil. And about a week ago, Jim Cramer said that the collapse of the First Republic Bank could mark the end of the banking crisis. That basically means that the whole banking sector is screwed, and it's all going to collapse pretty much imminently. But all jokes aside, since then, PacWest has been down more than 52%, Western Alliance has been down more than 22%, and it keeps on going. The whole banking sector is reeling, and the Fed continuing to raise interest rates is not helping things. As I continue to say, these interest rate hikes do work with long and variable lags, and it is going to be time before these do work their way through the economy and eventually slam into us in the middle of a deep recession. So the Fed should have done a pause already, but finally it does look like we are going to be getting the pause in the next meeting. But how much more stress can the banking sector actually take? Well, according to the Kobisi letter on Twitter, in acquiring First Republic Bank, JP Morgan has bypassed laws against acquiring banks while controlling 10% of the U.S. deposits, which means that JP Morgan is pretty much essentially being nationalized, shared $13 billion in losses with the FDIC, received a $50 billion loan from the FDIC, effectively bought back its own deposits, expects to profit $5 billion over the next 5 years, added $18 billion in market cap, and basically they just absorbed all of the assets of First Republic Bank while letting the FDIC take over all of the debt and bear the brunt of all of the losses. That means you and me are basically paying to bail out First Republic Bank while JP Morgan just reaps all of the benefits. According to Lisa Abramowitz, the FDIC estimated that the cost of the deposit insurance fund for the First Republic Bank insurance is going to cost them about $13 billion. This is on top of the $2.5 billion that it cost to bail out Signature Bank and the $20 billion that it cost to bail out Signature Valley Bank. Before bailing out First Republic Bank, they had about $105 billion left, and that means that if none of these other banks that have been totally crashing do actually end up collapsing, then they should probably have about $97 billion left. So why is the Fed actually continuing to raise interest rates? Well, there are some people saying out there that they could actually be trying to cause all of these banks to collapse so that they can consolidate the banking system, and then whenever the FDIC runs out of money, they can just start to reimburse them or refill their fund with FedNow or FedCoin. That would pretty much force the banking sector to start adopting FedNow or the CBDC that the Fed is trying to roll out in July. And all of this is probably amalgamating into a huge banking crisis in the middle of July, right around the time whenever they're rolling out the CBDC anyway. The question is this just a huge coincidence, or is this actually all by design? I'll let you guys be the judge of that, and let me know what you think down in the comments. For now, it does look like the Fed is probably going to be doing a pause in their next meeting, but that doesn't mean that they're not going to continue raising interest rates in further meetings, because right now it looks like they're just doing a pause so that they can start letting these interest rate hikes work their way through the economy and see where things are going to land us and if inflation is actually going to come down to 2%. But if they do continue to see hot readings on inflation going forward, then they might actually come back to doing rate hikes again and do 25 basis point hikes or something like that to bring down inflation if the markets do get too exuberant. For that reason, I don't think we're going to be hearing them talk about any kind of dovishness really, and they're probably going to continue saying that they're going to be hawkish. But as long as inflation continues to come down and these banks continue to collapse, I think we probably do actually have a pivot right around the corner before the Fed even says we're going to, because they say they're not going to do a pivot by the end of the year. Janet Yellen says that the U.S. could hit the U.S. debt ceiling by June 1st, meaning that the Fed is going to have to actually print to fund all of the government spending that they are going to continue doing, because they're not going to be able to cut spending enough for the Fed not to actually have to print money. Because even if they did just totally stop spending money, they still have more than $100 trillion in unfunded liabilities and $30 trillion worth of national debt, which we do have to service. And with interest rates being at over 5%, that means that this debt is basically becoming unserviceable. And with us heading into a recession, earnings are going to be lower, and that means that tax revenue is going to also be lower for the government, meaning that the only place that this money can come from is the Fed. So between the debt ceiling and this banking crisis, I don't think that the Fed is going to have any other option but to pivot by the end of the year. Traditionally, though, that doesn't mean that anything is going to be looking good for the stock market, because usually whenever the Fed does actually have to do a pivot, that's because there's a serious economic crisis, and that basically means that people are going to panic and try to get into cash positions. Whenever there's an economic crisis or collapse, that means that there's going to be reduced earnings, and basically there's not going to be very much gains to be had in the traditional stock market. That's why gold and bonds traditionally go up, and since Bitcoin has never been around in a real recession, I think this is going to be its time to really shine. Here we have the Bitcoin 2-year moving average multiplier, and as you can see, usually whenever it crosses to the upside over this green line, that is usually marking the beginning of a new bull market. Right now, we're just underneath the green line, and it looks like we're headed above it. So right now, it looks like it's going to be the best accumulation opportunity to get ready for life-changing wealth whenever we do ultimately get back going up into the bull market again. A lot of people have been talking about this sell in May and walk away. And looking here at the Bitcoin monthly returns, you can see that over the past 10 years or so, there's basically been a 50-50 chance of there being gains or losses in May. And so far this month, we're already up 0.75% according to this chart. And I think with everybody saying that we should have sold in May and walked away, the market is going to do the opposite, and it looks like that might have been some bad advice. In other news, looking at the bubble chart, Pepe is up 98% in the past 24 hours, which it was actually up like 150% earlier today. And Floki is up 33%. So it looks like the meme coin mania is continuing. And Pepe is also up more than 1,000% this week. And I'm pretty sure I saw it being up 1,000 or 1,500% earlier today, actually. It just seems to be having a little bit of a retracement, which could be a good opportunity to get in for the next leg up because it just got added to Binance and KuCoin today. As this article by Cointelegraph says, Pepe, the meme coin, has hit $1 billion market cap fueled by the Binance listing. A lot of people don't even know that Pepe has been added to Binance. And as people start to hear about Pepe being added to Binance and KuCoin, here in America, they're going to have to try to find probably a different way other than Binance because Binance US isn't actually listing Pepe. And as more people hear the news and the hype, I think that it could have another leg higher because it just became more accessible. Not to mention that now that it's got added onto Binance, some of their competitors might start to add it onto their exchanges as well. At the time of recording, Pepe is actually sitting in the number 40th place of all cryptocurrencies by market cap, which is pretty insane. And with it just passing $1 billion in market cap today, if it does just get up to the same market cap as Shiba Inu, it could still have at least a 5x in it. Let me know what you guys think in the comments. Has Pepe reached its ultimate peak and is it going to have a blow off top or does it have another leg higher? Either way, thank you guys so much for watching. I hope you have a wonderful day and I'll see you next time. Bye. This is Abisu. He's named after one of the 7 lucky gods of Japan. According to legend, he will bring wealth and prosperity to anybody who evokes his name. So don't forget to write his name in the comments or you'll bring dishonor to your whole portfolio. And check out this video right here. Say goodbye, Abisu.